Here's a powerful strategy you can start using immediately. With just 3 moving averages, you will quickly understand market trends. We'll also cover price action, along with movements of the EMA. Throughout the video, you will know the state of the overall market structure, whether it's ranging or trending, if there are impulsive or corrective moves, and if there is dynamic support or resistance. You know the score. Like, subscribe, and stay around for the full video. Let's look at a chart in an uptrend. I have added 3 moving averages, a 34, 89 and a 144. If you're unaware, these are from the Fibonacci sequence. Trend confirmation is understood by the following elements. Price must be above the 34 period EMA. The 34 must be above the 89. The 89 must be above the 144. Also note that the areas between the moving averages are increasing, and the 89 and 144 are not crisscrossing each other. During any trend, regardless of how short or long it lasts, price will always experience some level of pullback, known as a retracement. Having multiple moving averages is one way of understanding how far it's likely to retrace. A shallow or minor pullback will likely find dynamic support at either the 34 or 89, whereas a deeper retracement will likely find support closer to the 144. Looking at the chart here, we can see the first pullback just breaks the 89. A doji forms and the buyers try to push prices higher to continue the trend. However, it bangs its head on the 34, then again at diagonal resistance from earlier price action. Sellers try to gather momentum to reverse the trend, but an almost perfect candle formation appears, and within just 2 minutes, a long, or power candle, breaks straight through the EMAs. Momentum gathers immediately as the price pulls away from the moving averages. A downtrend works on the exact same principles as an uptrend, just reversing the positions of the moving averages. Once a breakout to the downside has begun, we are once again looking for a set of elements to come together. Without any one of these, the trend is not really confirmed. We need to see the price pulling away from the 34 EMA, preferably with some strong candles. All 3 moving averages should have untangled themselves from the previous range, and be formed with the 34 positioned underneath the 89, and the 89 to the underside of the 144. When all of the moving averages are separating from each other, with a nice area forming in between, this signals that the trend is currently strong. Even on a shallow or minor pullback, the 89 and 144 should not cross over each other, an area should be visible in between them at all times. During a deep retracement, it's expected that the moving averages will contract. However, for trend continuation, this should only be seen with the short and mid-term averages, the 34 and 89. The 144 should remain in a trending direction. When a market is in a range, the angle of most of the moving averages are flat. You will see price staying near the averages, mainly the short and mid-term. Even if the appearance of the moving averages is the same as a trending market, i.e. the 34, 89 and 144 are aligned, but flat, this still signifies a ranging market. You'll also see many crossovers between all 3 of the moving averages. It's best to keep out of the market in times like this. When the market is overextended, the trend will offer certain signals that a possible reversal is imminent. The first sign that often appears is undoubtedly the most important of all. Price is unable to break away from both the short and medium-term moving averages, 34 and 89. You'll see price stagnant, basically stuck in between these 2 averages. There is no current strength to push prices in either direction. When price breaks the medium-term EMA, in the opposite direction, be prepared for a possible reversal. When all 3 averages cross over, this is not an immediate signal to buy, but another key area to watch for possible entries on the first pullback. Moving averages offer dynamic areas of support and resistance when a strong momentum is present. Both the 34 and 89 EMA often work as rebound areas when price is showing strong impulse. They also offer dynamic support or resistance when the 34 and the 89 are running with an angle, not going sideways like in a ranging market. Medium-term moving averages in particular often act as rebound areas when the moving averages have an even sharper angle. You have another area when price reaches the 144 EMA, which is the last potential rebound area within the current trend direction. On every social media platform, trading chats on Telegram and most YouTube channels, the same question appears. Which is the best moving average? Which setting for which instrument? How many moving averages should be on a chart? The answer: who knows? I certainly don't, and I wouldn't want to advise you otherwise. Moving averages are lagging indicators, and therefore follow after movements on the chart. They should be used understanding this. There is no such thing as the perfect setting, as each trader will interpret the movements differently. You need to add 2 to 3 on your chart, on your preferred trading timeframe, and simply spend time looking how the moving average behaves around key areas of interest on the chart. The one which is most consistent for you is the one you should use, not what I or anyone else uses. Once you have researched and tested price behavior around key levels, choose your setting and stick to it. At certain times, price will break through your EMA, so you will amend it, and find that a different period matched better. But the next pullback either doesn't reach, or breaks straight through your new EMA, and when you check, your last setting would have been perfect. What I'm saying here, you will always receive mixed signals. Support and resistance won't hold or gets broken. Unfortunately, it's just part of trading. That's why any EMA strategy needs to be built on sound price action knowledge. That's where you'll find your trading edge. On this chart, I have 3 moving averages, all set at 89, which is the medium average I use on all my charts. I have one set to high, one to low, and finally, to close. This gives me my standard EMA, with a variation of the candle highs and lows in the same period. As the averages can get broken frequently, it's nice to see how much room for error there is, before you start looking to either close any existing open trades, or get ready to scalp a quick pullback. You can see here, how the medium-term moving average is highly significant. It acts as an extremely good rebound zone, giving some level of confidence when to open positions. A simple rule of thumb: price actions above it, I'm looking for long entries, action below, and I'm looking to either short or trigger an extremely quick pullback scalp. So, there you have it. A decent amount of information for you to take in on the 3 moving average strategy. Hopefully you found this useful and you'll be able to either add or tweak your own strategies to coincide with some of the points in today's video. Thanks for watching, stay consistent, stay profitable, and we'll see you in the next one.